welcome back to the Commission Desk. If you're new here, this is where we break down Bitcoin, crypto, and markets. No jargon, just what actually matters. Hit subscribe if you want more of this, and drop your questions in the comments. All right, today we're talking about something called digital credit, and honestly, this might be one of the more important shifts happening in Bitcoin right now, even though almost nobody's talking about it in plain English. Here's the basic idea. Companies that hold large Bitcoin treasuries have started issuing a new kind of financial product, high-yield, perpetual preferred shares, heavily backed by their Bitcoin holdings. Think of it like a credit product. Investors get a reliable cash yield, and in exchange, the company gets capital it can use to manage liquidity and grow its Bitcoin position without taking on traditional debt and without being forced to sell Bitcoin during downturns. Why does this matter? Because it turns a passive pile of Bitcoin sitting in a treasury into something active. Instead of just holding and hoping, these structures create an engine. Capital comes in from yield-seeking investors. That capital supports the Bitcoin position, and a stronger position supports the credibility of the yield product. It's designed to reinforce itself. But it's not all smooth sailing. Recently, one of these flagship preferred instruments went through real volatility, trading well below where it's supposed to sit near its stated value, especially during a stretch of Bitcoin price swings and broader market stress. That volatility exposed some real weak points and it forced a response. So here's what that response looked like, a five-part framework built to strengthen these products. First, reserves. Cash set aside specifically to cover dividend and interest payments was increased to roughly $2.5 billion, enough to cover more than a year and a half of obligations, with a board-mandated floor of at least 12 months. Second, the dividend rate on the flagship preferred was raised to 12%, with the explicit goal of keeping it trading in a tight range near its stated value, and that rate now gets reviewed monthly based on market conditions, not on autopilot. Third, up to $1 billion was authorized to repurchase these preferred shares directly to support the price. Fourth, a separate $1 billion was authorized for common stock buybacks. And fifth, the company can sell a limited amount of Bitcoin, but only for three specific reasons: rebuilding reserves, covering dividend payments, or funding buybacks when it makes sense, never as a random treasury dump. What's interesting is the investor protections baked into these instruments. If the company ever misses payments, there's a defined deferral process. Unpaid amounts don't just disappear, they accrue and step up over time. And if payments get missed for long enough, preferred holders actually gain the right to elect board members. That's not typical equity behavior, that's credit behavior with real teeth. There's also a leverage story underneath all of this. A lot of market participants have built up leveraged positions in these instruments, and there's meaningful short interest too, which can amplify price swings in both directions during periods of stress. It's a reminder that even Bitcoin adjacent products can get caught in their own liquidity dynamics. The bigger picture here is this. Digital credit is an attempt to build a parallel financial system on top of Bitcoin's scarcity, one that can pull in traditional high-yield capital that would normally never touch crypto directly. If it works, and if these companies keep proving they can manage volatility with discipline instead of panic, this could become a genuinely large, durable piece of how capital flows into Bitcoin going forward. Worth watching closely as this space matures. If this kind of breakdown is useful to you, subscribe and let me know in the comments what you want covered next.